Hello, everyone. Thank you so much for joining us here today. I wanted to talk about what we're going to be doing a little bit here today, introduce our host or the person who's going to be walking us through the R&D tax credits, the things you need to know, and what to do to kind of get what's coming towards you. So we are joined today by Brady Bryan from Brain Consulting. Today we're going to discuss specifically R&D tax credits and how Brain Consulting can assist you with what you may not know you're already entitled to. Brain Consulting is a niche firm that helps businesses with tax credits and other incentives. They do have a star-studded cast with lawyers, engineers, and accountants. They all have widespread industry experience from the Big Four and other national consulting firms. So again, today we are lucky enough to have the head of Brain Consulting here to walk us through R&D credits and how you can receive your own free phase one estimate for your business. So without further ado, I wanted to introduce you to Brady Bryan.
Oh, thank you, Ryan. Appreciate the introduction. Good morning and good afternoon, whatever the case may be. Thanks for joining us here today. As Ryan said, we're going to be talking about the R&D tax credit, the permanent R&D tax credit. And we would love to get questions from you as we're going along. We want this to be very valuable for you and to give you some takeaways. So feel free to reach out with questions and we will get started. A little bit about myself, a quick introduction. Born and raised in Houston, Texas. Spent the first 10 years of my career in the oil and gas industry. Went to Sam Houston State University, came out to LA to go to law school at Southwestern Law School, and went to work for Deloitte after that and worked in their R&D tax practice there. Started Brain in 2010, and here we are today. I live in Valencia, California with my wife and 3 children. I also have 2 French bulldogs. A little bit about Brain Consulting. We are a niche incentive consulting company. We do R&D tax credits, cost segregation, 179D, and other incentives as well, including fuel excise recovery, fuel excise tax recovery, and management consulting. And I don't know if this question is live or not, but feel free to chime in the chat or send in questions. But have you had any experience in claiming or helping to claim an R&D tax credit? And usually the answer is anywhere between 25 to 50%. But and that's quite all right. That's what we're here to talk about today. And you know, the takeaway is, what I want everybody to take away is that the R&D tax credit is a permanent tax credit now. There is a certainty and dependability and predictability about it. So it's something to check out on your client's behalf. Feel free to reach out to myself or another consulting firm, but you know, get it checked out and see what the opportunities may be. And here is this is kind of the framework for a lot of persons, I guess, perceptions of the R&D tax credit. A lot of people have in their mind maybe various connotations, but a lot of what people know about the R&D tax credit, especially if they have a negative perception, are based upon myths or something that is circa 2002, 2003. So the R&D tax credit, it's really, you have to think of it as really like a 40-year-old man or woman, a professional that has, you know, that's around 40 years old. You know, the first 25 years of their life, maybe not so dependable. Maybe there's a lot of gray area, as you see there in front of you. Maybe when they were at the fraternity or sorority, that's a different person than you see now. So that's just something to keep in mind. In those earlier years, the R&D tax credit was very difficult to take. So really that circa 2002, 2003, that's what a lot of accountants and our clients still know about the credit, the nightmare if you will, of what used to be the R&D tax credit. Over the last 15, 20, almost 20 years, we've seen so many taxpayer favorable things that have happened regarding the R&D tax credit that we're going to talk about. So just keep this in mind. It's really a dichotomy and a tale of two cities on the 2002, 2003 R&D tax credit versus the way it is now. And really, this presentation is not going to be like most that you may have been to with the R&D tax credit. We're not going to cover a lot of dry law. I have put in here really a overview postcard, if you will, on the R&D tax credit that we'll quickly go through. But I don't want to put anybody to sleep. But feel free to ask questions here. Number one, the R&D tax credit is now permanent. It's universally beloved on both sides of the aisle on Capitol Hill. And let's see, the definition of R&D is that the activity, the business component, or the project must pass a 4-part test. And you're going to hear that quite a bit. And there is a new emphasis by the IRS on, going back to the fundamentals of the 4-part test. And I'll cover that really quickly. Feel free to reach out to me if you have any questions on that. But we do have to pass a permitted purpose. That means we have to be doing something new or improved as it relates to a product or process. We can be doing something to improve the quality or reliability or whatever it may be related to that. And number two, we have to be dealing with the hard sciences. So we were dealing with principles of mechanics or physics or computer science. The big takeaway there is we're dealing with the hard sciences, not the soft sciences. So the social sciences and whatnot are not going to be qualifying. And the next two parts of the 4-part test are really hand in glove because you really can't have one without the other. Number one, we're dealing with a technical challenge, and that technical challenge has to be such that we have some kind of experimentation associated with that. It doesn't necessarily have to be, a if-then null hypothesis experimentation test set up, but it could be iterations, it could be trial and error, or we're at least evaluating 2 or more alternatives to make that technical challenge, to flesh it out, if you will. So that's a 4-part test. The 3 expenses we typically take: wages, supplies, and contract research. There are specific examples of that. I'm not going to really get into that. Wages primarily is the largest driver of qualified research expenses. We take a portion of the qualifying wages for those employees and apply it against their Box 1 W-2 wages. Big takeaway there is a lot of times you may have clients that are self-performing their R&D study, and likely they're leaving a lot of dollars on the table because they're maybe only taking 1 or 2 core persons that are doing R&D, and that direct support and direct supervision, which are also qualified pursuant to the Treasury regulations and other case law, are usually not looked at. So that's something to consider as well. What does this mean for your client? Back of the napkin number? Well, just federally, you're looking at really 4 to 7 cents on the dollar of qualifying research expenses. And over here, I gave an example of just one state. Oregon's state credit expires at the end of 2017, but there's about 40 other states with R&D tax credits, from California to Texas, you name it, Hawaii, many other states, and some of them mirror the federal tax credit, and then some of them are very different. Like Hawaii, you actually have to get certified. There's a pre-certification process. So it's just being aware of your surroundings, your tax surroundings, if you will. And so that's the main thing we're going to talk about there. Feel free to reach out with questions as we go along.
I think the question says, have you done this for craft brewers or breweries?
Yeah, so breweries, in fact, we do have distillery and brewery clients. There are quite a few qualifying opportunities. But what we would say, it's a target-rich environment. Since we're in here in San Diego, and quoting Top Gun there, we are definitely talking about a target-rich environment there. Both, you're going to have not only the process related to the beer, the craft brew, but also the product as well. So there's two different possible qualifying business components there. So yes, that's definitely a great opportunity to look at. So the first myth is what we do does not qualify for R&D. So a lot of people, when they think about R&D, they think about maybe Dr. Brown from Back to the Future, a crazy-haired scientist with a white lab coat, or beakers and graduated cylinders and all kinds of things in a laboratory. But R&D is not just for laboratories and lab coats. It's around 2003, after the Eustis case, it expanded to not only products but processes. So we're talking about manufacturing companies, we're talking about architecture firms, engineering firms, software companies, all kinds. It really opened the door for so many opportunities. Now, we do have to meet the 4-part test, but it cuts a much wider swath than what we used to know as within the definition of R&D for the Internal Revenue Code Section 41. So we're not only talking about products, but we're talking about new or improved processes and products. So that's the first thing, is getting past that first myth of what we do just does not qualify for R&D. The second myth is that we're a small company. Isn't this really made for the big companies out there, the Pfizers and whatnot? And so someone may think, oh, we're only about a $2 or $3 million a year company. This is not for us. And I would say au contraire, because we've seen so many taxpayer favorable changes as of late that and in fact, specifically for small businesses, startup, mid-sized businesses. For example, the computation methodology used to be very rigorous. We had to go back to 1983 and 1984 in many cases. Well, with a lot of small businesses, that record keeping requirement is very difficult. So really the Treasury Department unilaterally made a decision to allow for taxpayers to use a simplified method that requires really only going back 3 or 4 years, depending on the situation. And so that's much more favorable to small businesses and a lighter record keeping requirement there. Additionally, another thing we've seen is the payroll tax credit. So not only was the R&D tax credit made permanent, but we've also seen, if we're comparing that to a 40-year-old professional man or woman, but now they have a child, the payroll tax credit, which was created for that startup. So that myth that we're a small company, the R&D tax credit is just false. And the credit is for small companies, large companies, and mid-sized companies. And we're going to talk really quick about the payroll tax credit because it's very exciting and something that's brand new. I guess real quick on the payroll tax credit, if in general, now the rules obviously, there's exceptions to this, but in general, if you're a company that's performing R&D and are 5 years old or less and make less than $5 million a year, you can use the credit to offset your employer side of the FICA taxes. So, even if you're in NOLs or, not generating taxable income, you can still use this credit in the current period. And I really wanted to quickly get to an example case study, particularly around the time, here's a company that's not super large. Here's an architecture or services company, gross revenues of $1.8 million and payroll of a little less than $1 million. But this is still meaningful for this company. This is over $40,000 a year between federal and California tax credits. What is the architecture company doing that's qualifying? Well, they're doing work related to the building design. They are doing schematic design, design development, and construction documents related to this. So it's not a huge company by any stretch of the imagination, but it's a nice size architectural services company that works for other architecture firms and hotels and things like that. And this is, a decent tax credit particularly this is just 1 year, and you can go back typically 3 years under the statute of limitations. So if this company were to go back to 2015, 16, and 17, and including 18, right, we're talking about 40 times 4, $160,000 plus potentially in tax credits. So, that's enough to wet most people's whistle. And here's some more details on the payroll tax offset. I already kind of went over this already, but if you have any questions on the payroll tax credit, please reach out with questions here. And really wanted to cover the challenges here. On the payroll tax credit, we've seen some challenges. We've seen some payroll tax companies, some providers that are not processing this claim. I'm not going to name them on this call, but it's something to be aware of. Talk to your payroll tax provider. In general, you want to find a provider where the CPA can hand over the Form 6765, and that provider completes the 8974 and the 941. You also, for instance, one provider, and I'm sure there may be other similars out there, Gusto has a real-time payroll tax credit option for nominal fee. And so this, when you find a solution like this, you don't have to wait till that next 941 is filed. You can go ahead and start taking advantage of it immediately if that solution provider is, that provider is offering this solution. So otherwise, you'll have to wait till that next payroll tax return to utilize that benefit. Another thing to think about with the payroll tax credit is that in some cases, PEO, the cost of the PEO related to the qualified research expenses can be taken for wages. However, that's only where they have become a certified PEO program via the IRS. So that's another thing. So don't only check out your payroll provider, but check out your PEO. If your client is using a PEO, check out this list. The IRS publishes a list of their certified PEOs. This is a voluntary program that the IRS established. So that's something to definitely keep in mind and check out. Polling question number 2. What do you think the R&D tax credit is for? Inventions, patents, and new to the world discoveries? Products, development, product developments applied to engineering? Process improvements? Only 1 and 2, or all of the above? And we'll give you just a minute here. So we'll be and we'll give you just a few more moments there to answer that. And we would love any questions, you guys. Don't be shy about sending in questions. I want to tailor this and make it valuable for you. So. This is great. This is great. Okay, so we're going to bring it to a close here. And it looks like about 11% answered to product developments applied to engineering, and then almost 90% chose all of the above. And all of the above is correct. And I'm glad we had this question, because prior, you remember we showed on that chart, that arrow, that gray area. Remember thinking about that now professional person back in their fraternity and sorority days. It was only inventions and new to the world choices there. We really, that person almost had, that company almost had to do something to the level of patentability. In fact, there was, they used to apply what was called the discovery test, which we also call the Star Trek test. They had to go where no man has gone before. So evidently, somewhere along the lines of the IRS, there was somebody that was a huge Star Trek fan to come up with that language. So thanks for those answers there.
It looks like we had one question come in here. Can you choose to take the credits against payroll taxes or income taxes, or even against both?
That's a great question. So if you're taking them on an originally and timely filed return, you can elect for either or both. So that's a great question, Stephen. So if you look at the updated Form 6765, which I probably should include it in here, but if you just Google that, it's going to allow you the option to carve out as much as you want, up to $250,000 to the payroll tax credit. So great question, Stephen. Here is another myth. The process to receive the credit is too exhaustive. It's just too much of a rigmarole. And you know, maybe in the past with some folks that may have been true. It really depends on the consulting company that you're dealing with. So I would just say, you know, put your feelers out. Find a interview some tax specialists. Use a specialist that teams up with your CPA firm that makes things seamless. You don't want a CPA firm, or you don't want, as a CPA firm, a consultant that's just going to offload all the work on you and your client. You need someone that understands how you work, how your client works, and really tries to make life easier. And that's one of the things we pride ourselves in here at Brain, is just to make life easier on our clients, find out how they work, and really leverage as much as possible. So, you know, if the client is using project tracking, understanding that software there and harnessing what's already available rather than trying to reinvent the wheel. Start early, align your work plan with your tax filings, and that way that you can plan ahead. So for instance, a lot of our clients are already, you know, starting for 2018 R&D tax credit studies. Why? Because why not? I mean, you can go ahead and start now. You don't leave good money on the table and waiting until, you know, March 14th or September 14th to file. And you can go ahead and also blend it in with your client so that we can avoid their busy season as well. So I would say, you know, reach out, get that initial assessment for free. Obviously, we offer free ones. Beware of other service providers that you know are charging you for that initial assessment or asking you for an exclusive contract to sign up if they give you an initial assessment. So it should be you know, no strings attached. Another myth that we want to dispel: my company would be at a higher risk to be audited. So really, on a timely filed return, we have found no additional evidence of an additional risk of audit related to an R&D tax credit claim. A timely filed return has about a 2% chance of audit in general. On an amended return, it's roughly double those odds. And you know, it's just the additional risk on amended returns that just goes with having an amended return. Now, depending on the tax election, if your client is a C corporation, now that may increase it a little bit more, because the process for claiming an R&D tax credit for C corporations a little bit different. It has to be run through Ogden, Utah. So just keep that in mind. But at the end of the day, you know, I would say if your client is eligible for R&D tax credits, look at everything they're eligible for by year, by jurisdiction, and weigh it. You know, weigh the cost to amend the returns, weigh weigh, the benefit to the client, and does it make sense? You can never play the audit lottery game. So, and I would say, if your client does elect to, amend those returns and take advantage of those credits, whoever you use, make sure that those studies are done just very robustly. Make sure a good study is done. And it's like my granddaddy used to say, do it right and sleep tight. So no shortcuts and no lottery games.
Wonderful. Looks like we had a question come in. Here we are. So the question is, I have had 4 of these and 2 were audited. One was an amended return, and then no change in audit.
That's great news. Thanks for that feedback. Yeah, we see several audits, but that's just because this is all we do. And we've actually seen, some very interesting changing dynamics in field exams and appeals over the last several years, really since about 2007, some significant changes. So thanks for sharing that. And this is a huge myth that I want to dispel. The R&D tax credit is only for high-tech NAICS code type companies. So, clients are thinking, oh, because, if I don't have like a technology NAICS code on my tax return, that I can't take this credit. And that's just not true. The IRS publishes a list of types of companies, of industries that take advantage of the tax credit and utilize the tax credit. And there are over 65 industries are represented. Of course, the largest portion is information technology, software, but manufacturing, architecture, engineering, construction, energy, alternative energy, aerospace and defense, agriculture, electronics. I mean, you name it. Over 65 industries are included here. So don't let that be the end all. I mean, you may have a financial company that is developing software applications. You wouldn't think normally a financial company is doing R&D, but if they're spending money on software development and apps for their users, or even healthcare companies that are coming up with new software for patients, patient portals, things to improve patient compliance, reduce number of bed days and readmissions. We're talking about real R&D that's happening. So don't let the NAICS code or your categorization deter you from at least checking it out. Find a qualified consultant, look at whether or not you're doing R&D, and take a stab at it. So.
And as mentioned earlier, even brewers of beer.
Absolutely. Distilleries, breweries, wineries, great opportunities there. So that's a really good point. Thank you, Brian.
Yeah, absolutely.
And the third polling question, which industries are your clients in?
And we'll give you some time here for everyone to consider their options to choose.
Does it allow them to select multiple?
And if you're in multiple industries, you can just kind of chat in and let us know you chose manufacturing or architectural, and then say that you also represent other industries, which I'm sure multiple of you do.
Yeah, so I would just put the dominant industry down, and then if you can send a little message on a couple of the other secondary and tertiary industries.
All right, we're going to close the polls now and kind of discuss.
And that is really great to see. The 3 top categories that we're seeing, manufacturing, architecture, and engineering, are the industries where we most often see good qualifying R&D not even considered or left off the table. So manufacturing, that is my personal background. I spent 10 years in manufacturing in the oil and gas arena prior to going to law school. And you know, there is just so much R&D that happens. So number one, when you're coming up with the technical feasibility of whether or not you can even produce a part. So you think of your high-tech machine shop, and you know they need to go out and we actually have a case study on this. So we will we'll go from there. Do you have any?
Yeah, it looks like we had someone who, or Stephen answered all of the above, but his brewery is ready to get an assessment right away. So that's good. That's good news.
That's great. Would love to hear from you, Stephen. We'll jump on that right away. Okay, so here is a case study for software. This is a software company that is doing content management software for media outlets. They're always developing new and improved features and modules. This is about, and the reason there's a couple of things going on here would solicit some feedback from you guys. And so this is another, I included this for the CPAs on the call. This is a 15-year-old company, and they had an acquisition 5 years prior. So the prior, just consider all this. I know you've had some clients like this, and the documentation availability decreases significantly 7 years prior. Now we know that there's, and you may or may not know, there's two computation methodologies. We talked a little bit about. There's the regular credit computation methodology and the alternative simplified credit. So there's a lot of moving pieces here. This is a $24 million company, $4 million in payroll, but check out, here's something that's interesting. $2.5 million in QREs, wage QREs. That is a very high qualifying percentage related to payroll. Why? Because, for instance, architecture, engineering, software, these are very concentrated areas in the design arena. And so you're, just in general, going to find higher percentage of QREs to payroll in these areas than you will, for instance, with a general contractor or manufacturing company or what have you. This, at the end of the day, results in a $130,000 alternative simplified credit or a $170,000 net federal regular credit. It's just something to examine. You know, there's really no right answer. It's kind of like going back to your old SET or ACT. It's the best answer under the circumstances, right? So would you choose a regular credit here or an alternative simplified credit, even though it's $50,000 lower, a significant percentage lower? Well, you look at the 15-year history, you look at the acquisition, maybe that acquisition had brought over 0 records except for a couple of years tax returns needed by the lawyers. Or maybe, you know, also considering the documentation availability decreases significantly over that, you know, 7 years prior to that. These are all things, me personally, I would be leaning towards the ASC, because if this were examined, you know, we would want to have our strongest foot forward and have the best documentation available. So that's something to consider. But I just wanted to give this example because you really have to look at the facts and circumstances of this particular client and really have that evaluation. And if you have a consultant that you're using and you're not having these conversations, I would highly recommend asking why not, and then maybe find a consultant where, you know, you can have these conversations where you talk about the ASC versus regular credit method, or the reduced credit election versus an add back. So. This is R&D. This is a case study for civil engineering firm. I know several people said they had architectural engineering clients. And what are they doing? So civil engineering, you can, this civil engineer, you know, he was like, well, what do you think could be qualifying? We're essentially designing moving dirt. Well, these guys, you know, they have to really make everything safe and sound to build bridges and master planning, environmental remediation. So everything, well, not everything, but a lot of what they are doing on their schematic design development, and construction documents could be qualifying. And here again, if you look at their payroll and expenses, it's a pretty high QR, not nearly as high as the software company, you know, the 900,000 to 2.5 million, but it's a very decent amount. And here, this means $77,000 per year for that engineering firm. Again, that's just 1 year. You can typically go back 3 years, and so, you know, you're looking at 6 figures of tax credits there. And feel free to chime in if you have any questions on any of these case studies for similarly situated companies. Reach out. We want to hear from you. Okay. I also saw an example for the construction company, or I saw several people have construction clients. And construction is one of those areas where it's, you know, rarely looked at for R&D. But the key areas where R&D is happening there is really, and this is a mechanical contractor, a subcontractor in construction. They're designing HVAC systems, large HVAC systems for commercial properties. And so they are doing everything from BIM modeling, electrical detailing, and really constructability. And really part of their, I guess, technical challenge is the integration of this system with the mechanical engineering plans and the other plans as well, the electrical engineering, electrical contractors, and of course with the GC's own plans. So there's a lot of moving components, and these guys have to be perfect. So, and for this company, $50 million, again, if you look at the QREs to payroll, much lower percentage here, but we're still talking about $130,000 for 1 year alone. So we're talking about over 6 figures just for 1 year. So that's pretty significant. And also another thing for HVAC contractors and just general architects, engineers, construction in general, if they are designing these for government buildings, through 2017, there is the 179 capital D energy efficient commercial building deduction opportunity as well. So that's something to consider. Reach out if you have questions on that. And really the big takeaway here, and I know we finished up a little ahead of time, and I did want to talk about manufacturing again as well. I thought I had a manufacturing case study in here. The big, like I said from the get-go, the R&D tax credit is stable, it's predictable, it's dependable, and you know, it's something to look at for every one of your clients. So I really hope to dispel a lot of those myths. Really quick, I want to talk about manufacturing. That's one of those areas where, how are we doing on time?
Doing great. I think we'll, you know, maybe about 5 more minutes, and then we'll have plenty of time for question and answer.
Perfect. So manufacturing is one of those areas, you know, as you are, you know, you may have, for instance, a defense contractor that has a spacer to make for a, airplane or a helicopter or something like that. That's great. That's wonderful. They have the drawings on that. But as anybody in manufacturing knows, developing the manufacturing know-how of how to make that, how to program the machines to run that, how to develop the tools, jigs, and fixtures to be able to do that, and also to, you know, to extrapolate that. If you now have an order, let's say from Eaton, to do 100 of these spacers a year, and then that order changes to 10,000 a year, and you have to change your manufacturing center setup, and now you're running this through a 6-axis lathe Mitsubishi machine, all new tools, jigs, and fixtures, new programming, and now instead of using 10 machines, you're out there using 1 machine. You know, that's R&D. Much of what is going on there is R&D. So from the time you get the order, sometimes even getting the bid on those jobs, developing the technical feasibility, the conceptual feasibility of manufacturing that component, you know, through, and where R&D stops is the commercial production. But let's say, you know, the vibration in this helicopter we want to reduce that. We want to make a quieter Black Hawk helicopter. And so we found out that test studies show that if we got the clearance tolerance on the internal diameter of that spacer down from 15 thousandths to 5 thousandths, so that significantly reduces the vibration. So how do we do that? And so, a manufacturing company may implement statistical process controls or what have you to start studying how they can get that tolerance down and do it at a consistent rate. So at that point, that's a new R&D project. So even though they may have already been commercially producing those, now a new R&D project has come along. How do they improve the quality of that spacer, reduce the tolerances down, or actually improve the tolerances and make for a quieter ride to keep our soldiers safe? So, that's an example. That's several examples in manufacturing that people just a lot of times don't think about. So, do we have any other questions that popped up so far?
Yeah, I have some questions. I was going to save those to the end, or
does anybody else?
Oh, looks good here. Nope.
Okay, perfect. All right. Well, guys, feel free to reach out with any questions at all. Connect with me on LinkedIn, and let's go through some other questions here. They're coming up.
Yeah, a few questions are coming in here. Can you go back and amend returns to take the credit if you didn't take it previously?
Absolutely, that's a great question. So yeah, definitely you can go back in time and amend those returns that are open on the statute of limitations. Typically it's 3 years. Some states differ. California is typically 4 years. But again, it all depends on a particular situation. We had a client that was in NOLs many years, and we ended up doing a 16-year study for them because the statute of limitations was open for them for all of those years.
Okay, excellent. And then someone else asked a question, and this one might be kind of asking for a friend. Will I look bad as a CPA for not recommending investigating R&D credits when I didn't before?
That's a great question. I get that often. And, I would say definitely not, because, we have the law, everything has changed so much. The law has changed so much over the last 40 years. Remember, we had that earlier example of that timeline. That first 20 years, that was a shaky area. And that's where a lot of people still know about the R&D tax credit. And we've seen so many taxpayer favorable cases over the last even 3, 4, 5 years. And in fact, it was just recently made permanent. So I would say absolutely not. I would say it would make you stand out as a stand-up trusted advisor, in fact.
Oh, excellent. So another question, how much time do these usually take?
It's a great question. So at least with us, and I know we try to do a lot of the heavy lifting, a phase 1 estimate takes about 2 hours of the client's time cumulative. That's in getting the data and maybe a few follow-up conversations to really understand the qualifying activities and the activities in general at that company. And then a full-fledged study could take a client anywhere between 10 and 20 hours, depending on how large the company is and how many moving pieces. And that's cumulative. That's not all going to be put on the controller. That might be involving interviews with other subject matter experts.
Okay, excellent. It looks like we just have a couple more questions. So this training is very high level. Can you provide trainings that are more rules based and that go into the nuances of qualifications and case law?
Absolutely. So, we have a number of trainings, and I would, love to be able to present to your CPA firm or have you or come back for another webinar here, and go through the 4-part test and a lot of detail, go through some of the, methodologies, the calculation methodologies, and even, talk about tax controversy and the, lay of the land as far as exams are going right now.
Great, and then last question, this one's a good one to kind of wrap it up with. How much does this cost to get an estimate?
Great question. So I can talk about us, and I can talk about just the industry landscape in general. I would say most or a lot of consultants out there are contingency fee consultants. I would say run if somebody offers you a contingency fee. On an exam, one of the first things an IRS agent will ask for is a copy of the contract with their consultant. There's a reason for that, and I think we can all guess what it is. They want to see the financial arrangement between that consultant and the taxpayer. So I would say, obviously make your own decision, but at Brain, we only do fixed fee arrangements. The phase one analysis, the estimate you get is going to be free, absolutely free, no strings attached. If it makes sense to do it, great. If you go to another provider and engage them, fine. And we can shake hands and all still be friends. But at the end of the day, that's what you want, is to be able to take a look at what is available to you and make an informed decision based upon that. And then if a client does engage us, that will be we have fixed fee options. So, if the client wants to go back and amend returns, great. If they don't want to and just want to look on a prospective basis and look at, for instance, 2018 going forward, great. We'll have fixed fee options for all of those as well.
Excellent. I think that wraps up our questions that we had here today. Again, please feel free to reach out to Brady. I think we have maybe a slide with his contact information, or everyone who has joined us here today, we can get that out to you, get his contact information out to you. So Brady, thank you so much for walking us through the R&D credits here. We do look forward to getting people set up, getting that free phase one estimate. And thank you all very much for joining us as well.
Thank you, everyone. Thanks, Ryan. My pleasure.